Okay, so let's get into this whole situation with the Federal Reserve and the talk about tariffs. It sounds like Fed Chair Jerome Powell is signaling, well, a potential balancing act ahead.
Yeah, that's a good way to put it. He's definitely acknowledged that these tariffs, if they happen, could really complicate things. Maybe force a tough choice between clamping down on inflation or, propping up economic growth.
Right, and he talked about that dilemma, didn't he? Not saying they have to choose right now, but that they'd need to figure out where the economy actually stands on inflation and jobs.
Exactly, and how long it might take to get back to their goals for both. It's about assessing the damage, so to speak, if tariffs hit hard.
And for now, he was pretty clear, saying the Fed feels well positioned to wait for greater clarity. So basically, hold tight, no sudden moves.
That's the message. They're watching, they're waiting, but you could hear the concern, right? Powell definitely flagged the risk that tariffs could mean, well, the worst of both worlds.
Higher inflation and slower growth. Yeah, he voiced that explicitly. And you can immediately see why that's a problem for the Fed.
Oh, absolutely. Because their main job, that dual mandate we always talk about, is stable prices and maximum employment.
And tariffs act essentially like a tax on imports. So that could mess with both sides of the mandate.
It could. It's interesting, though, the history of tariffs and inflation isn't always like a straight line. Sometimes they push prices up. Sometimes the overall impact is pretty muted.
Yeah, the specifics matter a lot. Powell actually touched on that in a Q&A, didn't he? He said tariffs are, I think I'm quoting roughly here, likely to move us further away from our goals, probably for the balance of this year.
That's quite direct. A clear signal he sees them as a negative force, at least in the near term.
It really is. And hey, if you're finding this breakdown helpful, please do take a second to like this and subscribe for more updates.
Good point. Now, it's also worth looking at how the market's reading all this. The Fed Watch tool from CME Group.
What's it showing?
Well, right now, it suggests the betting money is on the Fed starting to cut rates, but not until maybe June 2025, and then maybe 3 or 4 cuts by the end of that year.
Okay, so the market sees potential trouble ahead, or at least enough of a slowdown, that the Fed will need to ease policy eventually, but not immediately.
Precisely. Now, usually Fed officials see tariffs as like a one-off price shock, something that raises prices once, but doesn't necessarily cause ongoing inflation.
But I sense a but coming.
The scale of the tariffs that were put in place or are being discussed again is pretty broad. That raises the question, is the old view still right? Or could these be big enough to have a more lasting effect?
That's a really important distinction. A small tariff on one thing is different than broad tariffs across, tons of goods. It could definitely ripple through prices more persistently.
It changes the whole dynamic. And Powell also noted that some of the near-term inflation gauges, things like surveys, market indicators, they are ticking up a bit.
So short-term price pressures seem to be building.
Seems that way. But he also pointed out that the longer-term outlook, what people expect inflation to be down the road, that's still pretty anchored. Still near the Fed's 2% target, maybe around 2.6% expected for March's reading.
So a bit of a split screen. Near-term heat, but long-term expectations holding steady for now.
Exactly. And that's crucial. Powell himself said tariffs are highly likely to generate at least a temporary rise in inflation. That's the baseline expectation.
But he also warned it could be more than temporary.
He did. He cautioned that the effects could stick around longer. It really boils down to, well, how big the hit is, how fast it spreads through the economy.
And crucially, whether those longer-term expectations stay put. If people start thinking inflation will stay high, that can become, a self-fulfilling thing.
Absolutely. That anchoring is key. Now, switching to the growth side of things, Powell mentioned the first quarter numbers look like a slowdown from last year's pretty solid pace.
Okay, so growth is easing off a bit.
Seems that way. And interestingly, while car sales were strong, overall consumer spending looks like it moderated somewhat.
And what about imports? I heard something about that impacting GDP.
Yeah, that's another piece. It looks like businesses imported a lot of goods in the first quarter. The thinking is they were trying to, get stuff in before any potential tariffs hit.
Front-loading imports. So that boosts import numbers, but actually drags down the GDP calculation, right?
Yeah.
Because GDP measures domestic production.
Exactly. It counts as a subtraction in the GDP math. So strong imports, paradoxically, can mean weaker reported growth for that quarter.
Interesting. And we saw that big jump in retail sales for March, right? 1.4%, better than expected.
We did. And part of that strength seems to have been car buying, possibly, again, people trying to buy before potential tariff-related price hikes.
Just shows how the threat of tariffs can change behavior right now.
Definitely. And after that retail sales report, the Atlanta Fed's GDP Now model, which tries to estimate growth in real time, actually revised its Q1 estimate down slightly to minus 0.1%. They adjusted for some unusual gold import-export stuff, too.
Wow, so minus 0.1%. That's quite a slowdown.
It is, although it's just one estimate and adjusts for those specific gold movements. But it paints a picture of maybe weaker underlying growth in Q1 than some other numbers might suggest.
Still, despite that potential slowdown and all the tariff talk, Powell described the economy as being in a solid position.
Right. He's acknowledging the headwinds, the risks, especially from tariffs, but he's not sounding the alarm about the fundamental health of the economy just yet. It's more like, things are okay, but we see this potential problem coming.
Okay, so summing it up, the Fed, under Powell, is clearly on alert about these tariffs. They see the risk of both inflation going up and growth slowing down that classic policy challenge.
Yep, a real potential headache for hitting that dual mandate.
They're in wait-and-see mode for policy changes, but they know these tariffs, if they're broad, might be more than just a temporary price blip.
And the markets are kind of betting that eventually, maybe starting mid-next year, the Fed will have to cut rates in response to whatever happens.
It really highlights that complex dance between trade policy, which is outside the Fed's control, and monetary policy, which is their tool.
It absolutely does. These tariffs just add a big layer of uncertainty. Powell's comments really drive home how tricky it is for the Fed to navigate when these kinds of external forces are at play.
Leaves you wondering how this will all shake out for the economy and what the Fed's next move will actually be.
It does. And maybe the deeper question Powell's hinting at is, how much can monetary policy really do to offset the negatives if significant trade barriers go up? Can the Fed truly achieve both stable prices and full employment if trade policy is actively working against those goals? That seems like the core issue.
Definitely food for thought. Well, that brings us to the end of our look at this today. We hope this gave you some useful insights into a pretty complex situation.
Yeah, there are a lot of moving pieces, and we'll certainly be watching how it develops in the months ahead.
Thanks so much for joining us as we explored the Fed's thinking on potential tariffs. And one last reminder, if you got value from this, please like and subscribe.
Thanks, everyone.